Well, good morning, everybody, and welcome to the Daily Energy Markets podcast. And that is indeed the question of the day that we're posting up on the web, on the podcast right now. We asked the survey question earlier. OPEC Plus will pause or reverse output cuts if Brent crude hits which number? And by an overwhelming majority, it was in the $100 plus mark rather than anything sooner. Let's kick off by going to Amina Bakr, Chief OPEC Correspondent and Dubai Deputy Bureau Chief at Energy Intelligence. No one with a sharper mind on OPEC's thinking than Amina. So, Amina, I put to you, can we expect Saudi Arabia to relent on their voluntary 1 million barrel a day cut, as clearly we're moving into a very tight market and $100 oil? Your thoughts?
Hi, Sean. Good morning, everyone. I think that the Saudis or OPEC Plus in general, Sean, they look at other factors than price. Of course, price is something that they monitor on a daily basis, but they are also tracking very closely what's happening to inventory levels, demand recovery levels, and on the demand side, there's still a lot of uncertainty, which prompted them in the first place to extend this cut until the end of the year. And the cut was really to manage inventory levels, and they were worried about Q1 starting next year. They want to keep things tight. As we saw in the beginning of this year, for example, we had a buildup of 700,000 barrels a day. They don't want to see a repeat of that in 2024. But with rising oil prices to 100, I mean, 100 isn't the goal. A higher oil price isn't the goal, but it's more about retaining that control and watching very carefully what consumer states are doing. I mean, one of the things that OPEC Plus watches very, very closely is the Fed. The Fed recently has been used as a market management tool by the US. So let's see how the Fed behaves. And based on that, I think, yeah, we'll wait and see what the Saudis or OPEC Plus decide.
Bora Barryman, Managing Partner, Hormuz Straits Partnership. The Fed has been used as a marketing managing tool by the US. I'm not quite sure where that takes us, but nonetheless, where is the Fed going? Where do you think, Bora, with this big number now on oil, regardless of whether it's managing the market into balance or into tightness, we're marching firmly up 30+% since the June low, since these unilateral output cuts were announced, and we're going in one direction. How do you think they impact the monetary policy makers as they perceived that they were arriving at the end of their tightening cycle?
Clearly, they, as you sort of indicated, they wanted to take a break on the tightening. They were creating a narrative that the momentum is in the right direction. Inflation is clearly slowing across most categories of goods and services, and that they want to essentially arrange a soft landing so that they can wait and see where the data leads them. Now we have this crude oil data indicator that is clearly at odds with the other indicators and the narrative that they had been preparing. What will occur? I think they will stick to the narrative, because usually the Fed is behind the curve. And the high oil price is another indicator that the economies are robust and they're absorbing it for the moment, right? So something's got to break. I don't think it will happen before the next Fed decision. So they will probably stick to the narrative, avoid another rise in the US. But that being said, the news out of Europe and the UK is fairly robust. The central banks are creating the story that wages remain strong, employment remains strong. The UK revised its GDP numbers upward over the past few years, so they're saying clearly there is space for another rise in the UK and Europe.
Matthew Wright, Senior Freight Analyst at Kepler. Matthew, OPEC Plus, as all of us would have been guided earlier in the year about the boy who's crying wolf, recession is coming, it's never come. But and so ultimately that idea that supply or demand would weaken, and so OPEC Plus and Saudi Arabia taking those preemptive moves to curtail supply. But of course, that sort of scale of economic weakness, recession, has not arrived. And I'm wondering, Matthew, given that the freight can always be a bellwether to where the future track is, we're seeing weakness in the outlook for freight rates. What can they tell us about economic health going forward?
Yeah, so I mean, freights in this case is very much reflecting what OPEC are doing. So, at the moment, VLCC rates out of the Mideast Gulf are the lowest they've been this year, going into last year, and are just steadily edging lower. This is typically the weakest time of the year anyway, so we're in the sort of the low summer lull, but we should start to see rates normally start to pick up towards the end of September. But this year, I think things might be a little bit different. The announcement they're extending cuts, weak buying from China, I think is all going to weigh on it. And I think the points you make, the fact that recession was expected or, sort of expected across the EU zone and the US and hasn't really materialized. I do think we should be wary, because I think the EU zone is still looking, Bora highlighted that the UK revised GDP numbers, but you've just got to look at Germany to see what the situation going on there. And I think we're not out of the woods for the EU. Saying that, diesel demand is actually comparatively robust, but there could be a lot of other factors at play there. I think we do still need to be quite wary that demand is not as strong as perhaps we might think it is. But yeah, for freight, I do think we're in for a bit of a weak fourth quarter. Rates normally start to pick up around now, and I'd be surprised if we see anything near what we saw last year or in previous years around this time of year.
Amina, we've had an interesting development this week, if you like. The IEA OPEC face-off has come, emerged in the public domain a little bit more than it usually does. The outlook for that, I mean, in both cases, however, there is an agreement that going into the fourth quarter, demand will exceed supply. And I'm wondering, as you said in your earlier point, when does balance, how tight is tight that we control the market? Does OPEC plus Saudi Arabia have appetite for? Because clearly even both of those two sort of opposing parties, if you like, I mean, in a sense, they're not seeing eye to eye in many ways at the moment, but ultimately they're seeing eye to eye in that the fourth quarter demand will exceed supply. And I'm sort of trying to get at how tight and how much control do you think Saudi and the OPEC Plus have appetite for? Inventories in the US are at, significant lows, et cetera.
Yeah, that's the $1 million question, Sean. It's really hard to gauge, because they used to give us a metric before, saying we want inventory levels to be this much or by this average, but this time we don't have that metric. So it's really difficult to see when they are going to be easing those cuts. We expect that perhaps this will happen once they see what inventory levels look like in the first quarter of 2024, and we might start seeing more easing of the voluntary cuts first. And remember that the entire group has the 2 million barrel per day cut until the end of 2024. So that's in place for the entire year. But another point is that by 2024, they're going to be doing the revision of the baselines for all countries. And a country like the UAE, for example, has been increasing its production capacity. It's at 4.6 million barrels according to its website now. So countries like
just remind us, when is the next time they have to revisit that? What does the current period extend to? The current quotas?
So the revision of African states, that's going to happen in November at the next OPEC meeting. And then in 2024, some point, there's going to be also a revision for the entire group. They're going to look at, assess the capacities of the entire group and perhaps, make changes. And one of the countries, as I mentioned, is the UAE. So we might see more of these countries who have the capacity wanting to add more production. So that's a kind of an indicator or a small clue, if you may, that when we're going to see more supply come into the market.
Bora, of course, the sort of other $1 million question, or whatever the number is these days, it used to be the $64,000 question is, and I suppose that seems a little bit out of date. But nonetheless, the question of what is the impact of prices at these levels, and perhaps that's another thing that Saudi and OPEC Plus is testing. We had an interview this week on our halftime talk series with the senior KPC official who was saying that 90 to 95, isn't what it used to be. And we went through obviously a few years in 2011, 14 with above 100. So testing or getting the market and the economy comfortable with 90 to 95 or in the 90s rather than anything lower. Is that viable under these current economic sort of outlooks, a global GDP growth rate that the IMF World Bank has said is going to be around 2% this year?
Again, that is the mystery question. And
but clearly $90 isn't what it used to be. I mean, we're all feeling the cost of a latte these days is nearly $10 in most urban centers.
Indeed. I just look at the petrol pump in the UK, £1.50 odd for a liter of petrol. I think that's what it was more than a decade ago, 15 years ago, right? So how relevant is it? Are people complaining about that? I think what people are complaining about in London is they can't even afford to drive with the environmental charges, the ULEZ charges. So that is offsetting
I suppose that's something they have control over rather than
living standards by much more than the cost of petrol is offsetting living standards, and people are clearly complaining about that. So I think in Europe and the United States, there are so many environmental levies, carbon levies that stack up multiple times above and beyond the price of crude. However, clearly the new BRICS allies of very important OPEC member states, India and China, they are, I think, at in a more tenuous position. But
we did have the Indian Narendra Taneja on yesterday, a senior energy analyst in India, close to a lot of the thinking and policymakers there. He was screaming at these price levels.
That's interesting, and he's a specialist, right? And he's an expert on this sector. But when I speak to
and close to the BJP, who are going into election cycle now.
Yes, but when I speak to Indians at sort of at the macro level, and as I'm sure you this is all anecdotal, but we all hear great bullishness and fantastic growth stories and investment opportunities. So, and I'm sure many of these investment opportunities are being pitched to people in OPEC capitals as well, and they might be sensing, India is on a roll and nothing can stop it, and maybe they're not worried about $100 oil stopping India's juggernaut, because there are so many like mega trends behind the India story today that they will continue to import more incremental crude there. So I am on the side of OPEC, sticking to their guns. There will be a lot of critical analysis and narratives coming out of all the consuming nations, but especially the United States and Europe, toward OPEC's policy. But I think it's more due to sort of geopolitical alignments rather than the microeconomics of the oil business.
Matt, we had the news today on the outlook. China's factory output and retail sales grew at a faster pace in August and sort of gave us some industrial output rose by 4.5% in August, et cetera. So there's some, positive data points emerging out of China after a period of sort of weaker ones. I'm wondering, are we seeing that reflected in freight rates? Let's say the biggest trading route or shipping route between the China and the west coast of the United States, for example. Are we seeing this outlook for China in the freight in the tanker rates, as we saw near record tanker oil imports into China last month? Are we seeing the China story reflected in shipping rates?
Not at the moment, and I think the reason is it's sort of one good data point among a number of bad data points. I think you just got to look at what's happening in the other sectors, particularly in property. Obviously, that's going to have more of an impact on the dry bulk side, but it's more reflective of investment and industrial activity. This is definitely a promising sign, and I think it will mean that in the coming months we start to see rates come back up, because China accounts for the vast majority of VLCC demand, and VLs tend to drive the wider dirty tanker market. Although we did have this interesting situation last year where, due to what's going on in Russia, we had the Aframaxes and Suezmaxes almost wagging the tail, wagging the dog. At the moment, no. So China, if you actually look at the number of ballast VLCCs heading into the Mideast Gulf, which is where the majority of crude heads to China, it's the lowest number in over 5 years. Really, really low expectations of loadings. A lot of the reason for that is because we do have more activity coming out of the Atlantic, and a lot of that it does go into China, but everything is very, very low and weak. There's not a lot of big numbers. A lot of owners are preferring just to stay in the Atlantic and do short haul, because what they don't want to do is take a long voyage on a low rate and then the market turn and they miss out, just because it takes a month and a half to get to China and a month and a half to get back. By that point, the market might have turned. So really, it's a wait and see. The big numbers in terms of arrivals into China is sort of a delayed response to when when the market was stronger on the freight side back in late spring, early summer, when we were seeing higher freight rates. But we've had such high stocks in China. We've had such we've really seen volumes from the Atlantic Basin and the Mideast Gulf pull back over the last 2 months quite significantly. So I'd expect that arrival number to drop very sharply over the next month or two. And as they draw down in stocks, reevaluate, work out. I think in some ways, what we might almost be able to ignore what's happening industrially and just focus on their clean export market, because they've the new product export allocation of 12 million tons on the clean side works out about around 1 million barrels a day, September through to the rest of the year, which is above what they were exporting so far this year. So we could almost have a situation where you can almost ignore the domestic market, which to an extent, and have refinery runs. I think I saw something this morning are at a year high. So that's the kind of thing that's going to help sort of lift the tanker market. Almost close your eyes to what's happening domestically for the next couple of months.
Amina, the sort of other big story this year for the oil supply side, OPEC Plus, as Saudi has given up this voluntary 1 million barrel a day cut, we have seen Iran increase its its production and its ability to get oil to market despite sanctions. And so in a way, the Saudi move has kind of counterbalanced the Iranian increase and in some way made space for that. And we have now the expectation that the US and Iran are going to do a prisoner swap deal, which has been very heavily publicized. It's meant to sort of take place this Monday after this weekend. I'm wondering from where does that leave Iran, the ability to bring more oil to the market? It's obviously brought a lot in the last year as Saudi has pulled back a bit, and the outlook for Iran and perhaps other OPEC countries, Venezuela and elsewhere, but Iran in particular, on the back of this deal with the US, whether they could bring more oil to the market.
Yeah, absolutely, Sean. We've seen a lot more volumes come out of Iran. Our estimates for August, for example, they managed to reach about 3.1 5 million barrels a day, and we see that increasing further. And I just wanted to go back to something that you've mentioned about Asian customers complaining that the prices are too high. We're still in a two-tiered market where you're getting a lot of discounted crude, including the Iranian crude. So you have discounted Russian barrels, you have discounted Iranian barrels, and this is something that is conscious. I mean, it's something that that OPEC Plus looks at very closely. Whenever they hear complaints from consumer sides, the response is always, okay, there is room for discounts in this market because we're still, in the situation where you have the conflict ongoing, et cetera, and Iran is increasing its production. So, and Asia is taking advantage of these discounted barrels, whether it's China or India. For Iran, yes, we are expecting more volumes to be produced, but in terms of them getting an OPEC cap, that's still something that they won't accept at all. They are still technically under sanctions, and they've said many, many times that they will not have a cap unless they reach pre-sanction levels and all sanctions are removed. And honestly, I'm not even hearing among the delegations that there's a need to put a cap on Iran.
But in terms of obviously that nothing official, but ultimately the accommodation of Iranian barrels more coming back to the market, and the indication, at least from American policy right now, seems to be to turn a blind eye to sanctions. OPEC Plus and Saudi Arabia would have to take that into its mathematical considerations as they, look to balance the market, as they call it.
Yeah, sure. These volumes are being accounted for, but it's no longer, we've kind of moved from the idea of it's a market share war to a point where it's all about maintaining control, making sure that the management tools that they have are effective and efficient and counter whatever negative sentiment is out there. That's a lot more important than market share. Long term, I mean, Saudi always looks at the long term here. They have the resources, they have the cheapest barrels. Now they're going to have the cleanest barrels too, through all these technologies they're investing in. So it's about really, looking at decades from now and not just today.
And the Saudi Energy Minister, Prince Abdulaziz bin Salman, has been very clear about his strategy to tackle the shorts, to make them ouch, as he called it. That clearly the policies they're following now keeps the shorts, I would think, very much on the sidelines. Let's go to the survey question and get a view from the room here. Again, do you expect Saudi Arabia to relent on 1 million barrel per day voluntary cut as we approach $100 Brent? Will it change the strategy? The Saudis have said that they can revisit this on a monthly basis, and will do so, even though they have announced that their voluntary cut will extend to the end of the year with a review each month. So they have that option and opportunity. Will this be something that triggers them to do that? Bora, we've had the ECB announce their latest rate hike yesterday to the highest level interest rates of the ECB, I believe, in history, and yet the euro fell, which seemed a bit odd. What's the outlook there, do you think, for this idea of deflation, where interest rates have to keep rising, inflation to tackle inflation while economic growth is declining? Is that a trend line we're now firmly on in Europe, and perhaps there's talk of it in China as well?
I think that's going to create some great economic frictions.
They have to choose, right? Clearly, the ECB chose tackling inflation yesterday over economic well-being of maybe employment.
Yes, but exactly. I think there are so many narratives, counter narratives, and cross currents here. Perhaps the European Central Bank has been more sensitive to the criticism that they were behind the curve on inflation, and they want to sort of regain the moral high ground. I think the Americans are much more nimble with respect to moral high ground. They can pivot 180 degrees like on a pirouette, right? But the Europeans are a bit sort of clumsy in that regard. But that being said, what we're looking at is they must be looking at this sort of populist backlash. How do they damp that down? Is it with reducing inflation? I think that's not going to be the only thing that makes people happy. If their industries are being shut down, the malcontent will continue, and maybe even be worse if unemployment is higher. So it's a very difficult situation.
So which data point does one look at here, do you think? I mean, what do you do? What do you look at for that sort of North Star direction? Because so many counterintuitive trends. We've had equity markets still soaring at near record highs, while talk of China slowed. I mean, and yet China's importing last month at least near record levels of oil. I mean, what data point gives one the sort of North Star direction if you are the Fed or the ECB or Bank of Japan or otherwise?
It's a political decision, and there are very different sort of values.
I mean, the Fed would say their North Star is 2% inflation rate because that's their mandate as a legal entity. That's what they're meant to do.
Yes, they would say that, but they're not increasing, right? The inflation is still at 3, but they're saying we're coasting toward 2. Look, for me, what's very important is the kind of if I were in their shoes, I would want my industry to be thriving. Clearly, that's not occurring in Europe. But they can put that down to Russia or the war in Ukraine or the energy transition that they have to do for moral reasons. So we have to shut down nuclear and hope that the solar catches up. And this is a temporary blip on our industrial competitiveness. But look, I'm really worried about what's happening in Germany. This was Germany is the glue that holds Europe together, being able to pay in the large surpluses into the budget so that they can distribute to the member states. And if German industrial production and capacity utilization continues to be so dire as it has been in recent quarters, let's say early next year, all bets are off. Unconventional, unorthodox policies may return just to get some energy into this market, to mix metaphors and puns. You know, there's something missing in Europe. That spark is missing clearly, and there is a malaise there. And when you've seen these Twitter or TikTok videos going around about the Chinese ambassador sort of speaking disparagingly to the UK economy, saying, look, you're not even a competitor. What do you do? Well, I mean, UK is a competitor to France and it's a competitor to Germany. So in a way, it's saying to all of Europe, what do you do that's relevant? And because there isn't the semiconductor manufacturing, there is more.
Well, what they do is consume. What they do is consume a lot of Chinese products, and so I suppose they're a market, if nothing else, at least for the time being. Matthew, just wanted to get your final thoughts as we wrap up. It's a little bit big window time over the horizon stuff, but nonetheless, this announcement out of the G20 of this new trade corridor. Obviously, it's all about shipping and rail and moving of things, India into the Middle East, into Europe. Is that as big a game changer as the headline suggested? So much of it seems to be already in place, but of course, connecting Saudi Arabia and Israel in the same trade corridor is new. But in terms of the shipping and other pieces, would more volume move? What's your thoughts on its impact for shipping?
Yeah, so I mean, a lot of it's definitely political, and it's about the announcement. But I think one trend that we're seeing generally across the board, particularly on oil, is the centers of production and the centers of demand are kind of moving further away. So for example, we've got more refineries in the Middle East in centers of oil production, but not necessarily in centers of demand or growth demand. So we're going to be seeing bigger shifts in terms of where products are being produced to where they're being consumed, which is only a good thing from a shipping demand, which is why you do need why you do need to invest in logistics, you do need to invest in this infrastructure.
Last word to Amina with the survey result. Amina, your thoughts on the other question that so no, Saudi won't relent. I will post that on social to see if that's a view that's shared there. But I wanted to sort of build on that question to the point of which, underpinning it, of course, is that that Saudi Arabia is carrying a lot of the heavy water here. I mean, Russia is doing a little bit, putting aside the war, sanctions, whatever. Russia continues to export nearly as much oil as it can, and few are carrying the same burden of this price point that's currently being enjoyed by everybody. Is there any narrative within OPEC Plus that Saudi will only do that for a certain length of time? We don't want to be the swing producer is a common refrain. Your thoughts on that point?
No, I think, Sean, it's because they have this enormous capacity and capability to bring on and off production. I think this is a role they will continue to play and continue to play in their favor too. And I mean, with the survey, I think you've got majority no, because perhaps a lot of people realize that the price point isn't the only factor the Saudis look at, and there are other dynamics at play here. Of course, I mean, as you said, it's up for revision every month. They're going to look at what needs to be done, and yeah, let's wait and see.
Well, I suppose we'll have to see what impact the tightness has in the point of view of no price but supply demand. It's hard to see that demand could exceed supply by 1.5 million more barrels every day for too long. Putting price aside, that dynamic doesn't seem sustainable for if indeed those reports are accurate according to the different multilateral agencies. I think that would be one to watch. But as it stands right now, Brent trading this morning in Asia at $95 a barrel, well above the sort of 1 year high, if you like, since last year. So a big number in that context, but maybe it is a number that major economies can absorb, even India, as it grows at 7% and 8%. Amina Bakr, thank you so much. Great to have you guys back at the table. Matt Wright and Bora Bariman, thank you very much. We look forward to seeing you all again soon, every morning and next Monday, 10:30 UAE time. Have a great weekend. All the best.